Back in 2008, the entire global economy, it came this close to completely falling apart. I mean, we're talking about a crisis that just vaporized trillions of dollars, cost millions of people their jobs, their homes, and you know what? We're still feeling the aftershocks today. So the big question is, how did it all happen? To really get it, we've got to look under the hood of the giant economic machine that got us there in the first place.
Now listen to this quote. This isn't from some disaster movie. Nope. This is what the chairman of the Federal Reserve, Ben Bernanke, actually told the U.S. Congress behind closed doors. Can you imagine? It was pure, unfiltered panic right at the very top.
So let's zero in on September 2008. This was it, the absolute climax of the whole thing. The entire global financial system was, well, it was teetering on the edge of a cliff. And the one question on everybody's mind was, how in the world did we get here?
And in just 1 week, bam! Lehman Brothers files for the biggest bankruptcy in U.S. history. At the same time, the insurance titan AIG needed an $85 billion bailout just to stay alive. But here's the thing you have to understand. These headlines didn't just pop up out of thin air. This was the sound of a dam breaking after years and years of pressure building up. So to really get it, we have to go back and look at the fuel that was feeding this fire.
Okay, so before the crash, there was this massive, and I mean unprecedented bubble. The best way to think about it is like a giant economic bonfire, just waiting for a match. And it was built with three, let's say, highly flammable ingredients.
So what were these ingredients? First, you had ridiculously easy credit. Interest rates were at rock bottom. Now, all that cheap money had to go somewhere, right? And it flooded into the housing market. This created an absolute frenzy, where it felt like home prices could never, ever go down. Then you had Wall Street jump in and basically pour gasoline on the fire. They came up with these super complex financial products so investors all over the world could bet on this boom. And it was all built on one little thing, the subprime mortgage.
So what exactly is a subprime mortgage? Well, it's pretty simple. It's a home loan given to someone who's considered, a higher risk. Maybe they don't have a great credit history. To make up for that extra risk, the lenders would just charge them a much higher interest rate. Makes sense, right? At least on the surface. But the difference between a normal prime mortgage and a subprime one, it was night and day. For a prime loan, you needed the usual stuff: good credit, proof of your income, assets. But in the wild world of subprime, lending standards basically went out the window. We're talking about loans with very little or sometimes zero documentation. They even got a nickname: liar loans. And yeah, there was a good reason for that. This just flooded the entire financial system with a massive amount of hidden risk. And just look at how fast this thing blew up. I mean, check out these numbers. In 2003, subprime loans were just a tiny slice of the market, right? About 8%. Fast forward just 3 years to 2006, and they're almost a quarter of all new mortgages. That is an insane jump. The whole system was just drenched in these risky loans. But don't worry, Wall Street had a plan for what to do with them all.
This plan was called the securitization pipeline, and it worked kind of like a factory assembly line for risk. Step 1, a lender or broker makes a loan. Step 2, they take thousands of these mortgages and bundle them up into something called a mortgage-backed security, or MBS. Then they take those and slice them up into even more complicated things called CDOs. And finally, they sell these products to investors all over the globe. And right there, that's the fatal flaw. See, the person who made the loan got their commission up front and then immediately passed the risk to someone else down the line. They had absolutely no skin in the game, zero reason to care if the borrower could ever actually pay the loan back.
So you have this incredibly complex system built on a mountain of risky loans. What could possibly go wrong? Well, soon enough the cracks started to show. By 2007, the air started hissing out of the housing bubble. Home prices, which everyone assumed would go up forever, suddenly stalled. And all those homeowners with subprime loans, they started defaulting. And that's when the dominoes really began to fall.
And man, when they started falling, they fell fast. It came in waves. First, the lenders who were actually making these subprime loans, guys like New Century, they went bankrupt. Then, the shockwave hit Wall Street. The investment bank Bear Stearns just collapsed. By September of '08, the U.S. government had to step in and seize the mortgage giants Fannie Mae and Freddie Mac to keep them from failing. And then, the big one, Lehman Brothers filed for bankruptcy. And that's what sent a wave of absolute terror through the entire global financial system.
If you want to understand just how devastating this was, all you have to do is look at the stock market. In October of 2007, things were great. The market was roaring, hitting an all-time peak. It felt like the party would never end. The whole system seemed completely invincible.
And then the bottom just dropped out. Less than a year and a half later, the market had been sliced in half, a 54% drop. That's just a staggering number. And let's be clear, this wasn't just numbers on a computer screen. This was the real-life evaporation of people's wealth.
So how much wealth? $11 trillion. Just gone. Think about what that actually means. For millions and millions of ordinary people, their retirement accounts, their kids' college funds, their family's entire financial safety net, it was just wiped out.
Okay, so the entire global financial system is in a nosedive. It's a total free fall. At this point, governments and central banks, they had to do something. They had to intervene on a scale that was totally unprecedented. It was literally a race against time to stop the world from plunging into a second Great Depression.
And the first move from the U.S. government was a number that just stunned everybody: $700 billion. This was the famous, or infamous, depending on who you ask, Troubled Asset Relief Program. You probably know it as TARP. It was basically a massive bailout designed to pump cash directly into the failing banks to, hopefully, stop the bleeding.
And believe it or not, TARP was only the beginning. This was a true whatever-it-takes moment. The government was throwing everything but the kitchen sink at the problem. They were pumping capital straight into the biggest banks. They did a federal takeover of AIG. They even guaranteed regular money market funds just to stop everyone from pulling their cash out at once. At the same time, the Fed cut interest rates down to basically zero and started a new program to pump money into the economy called quantitative easing. Seriously, every tool in the toolbox was on the table.
So all these drastic emergency measures, they worked. They stopped the immediate catastrophic collapse. But the crisis left behind a really deep and lasting scar, not just on the economy, but on millions of people's lives. The recovery was going to be anything but quick and easy.
And this is where you can really see the human cost of it all. Just look at these numbers. 8.7 million jobs gone. The unemployment rate shot up to 10%. We already talked about that $11 trillion in wealth that just vanished, and maybe the most painful number of all, nearly 12 million homeowners faced foreclosure. This wasn't a Wall Street problem anymore. This was an absolute catastrophe for Main Street.
Naturally, the response to all this was never again. So Congress got to work and passed this huge piece of legislation called the Dodd-Frank Act. It was the biggest financial reform since the Great Depression, and the whole point was to prevent another meltdown. It forced banks to hold more capital, it created a lot more oversight, and it was designed to clamp down on the exact kind of reckless behavior that got us into this mess.
But here's the thing about finance. Memories can be pretty short. Just a decade later in 2018, some of those tough new regulations were actually rolled back, specifically for the regional and mid-sized banks. This meant they were no longer under the same kind of strict supervision that the biggest banks were.
And that brings us to the big, lingering question, doesn't it? With the memory of 2008 starting to fade and with the financial world always inventing new and complex ways to do things, are we actually safe from the next crisis? Have we really learned our lesson, or are we just setting ourselves up for the next big fall?